Okay, good morning. David Weiskopf. I'll call the meeting of LoSAP to order. And first on the agenda will certainly be the roll call. And we'll start to my far left, which would be Commissioner Hewitt. Here. Catherine Pratson.
Here.
David Weiskopf.
Mary Ann Murray.
Jeanette Cudmore.
And in the audience helping us, we have Ms. Jody Kwasny and Michelle Rance. And the first thing to do is to approve today's June 4th agenda.
I move to approve today's agenda for June 4th, 2021.
Do I have a second?
I'll second.
All in favor?
Aye.
Ayes have it. And the approval of the March 25th meeting minutes. Do I have a motion?
I'll make a motion to approve the March 25th meeting minutes.
All in favor? Oh, I need a second. I apologize.
Second.
All in favor?
Aye.
Aye.
Ayes have it. Thank you. And today, we're going to start with presentation, which is Mr. Pat Winger from Marquette Associates, doing a quarter ending March 31st, 2021 performance report or portfolio update.
All right, great.
Take it
Thank
away.
you. And good morning, everyone. It's nice to see you all again. So we have a couple of books within the packet. If you open up the silver clip there, the first deck on top is the quarterly performance report. And we'll probably spend a little bit more time walking through the report today than we will moving forward, given that our last quarterly meeting, we ran through the previous advisor's report. Today, it's our first report to share with the committee. So we'll talk about some of the pages that we necessarily won't walk through every time out, but just show you the high-level information and hit on the important characteristics within the fund. But if you could hop behind that back cover and then behind the cover page and just look at the table of contents quickly, to talk a little bit about how this book is structured. So you can see the exhibits there listed. Normally we provide a Marquette update. So this is just behind the first cover page.
We're on LoSAP now, or?
LoSAP.
Yes, so I think it's the other book there, Commissioner.
We had two books for LoSAP.
Yes, sir.
Sorry about that. Oh, hey, thank you.
You're welcome. So in the table of contents there, you can see the first section. It's just an update on Marquette. We will rarely, if ever, get into that unless there's something relevant for you all to consider. We'll really start our discussions with the market environment. When we met last in February, we did provide our market environment for context. It's an overview, what's going on in the economy, what's going on in markets, just to provide context for how the trust did and how some of the investment managers performed during the quarter. And then as you work your way down there, we have a portfolio overview and then information on the investment manager. So our report is basically a high-level information of cash flows, market values, returns, asset allocation, and then we break it down more granularly. So we look at the asset class level, the individual manager level, and then provide characteristics for asset classes and individual managers. The latter two mainly for context. In case there's a question that comes up about a manager or how the pieces are fitting together, then we can use that as an illustration to help answer that question. So with all that said, if you hop behind Exhibit 2, again, we'll skip over the Marquette update and get into the market environment. We'll spend a little bit less time here than we will at the OPEB meeting, just given the straightforward nature of the trust. You know, the asset allocation being relatively straightforward, and then the implementation using all passive investments. We start at page 6 there where you see U.S. economy, and look at the top left bullet there. It's been a very strong start to the year. You can see in that first sentence, we saw economic growth come in at about 6.5% in Q1, really on the back of the themes we've talked about previously. Very strong consumer spending, certainly aided by policy support, namely the fiscal support coming out of Washington, where we've seen a number of packages come through over the past 12 months. Now, if you shift gears and look at that top right chart, specifically those last 3 columns that are striped there, those are economists' estimates for the remainder of 2021. And they're very strong to round out the year. And if they come to fruition, we're looking at the best year for economic growth in the U.S. calendar year since 1984. So a very strong economy continues to really fire on all cylinders, again, on the back of that policy support that we've seen. Now, since we have such a strong economic environment, again, this historic policy support, if you look at that second bullet point on the left towards the bottom, we have seen some inflation concerns begin to bubble up to the surface here. Most notably, again, the economy's running red hot, the policy support, but we've also seen a big jump in commodity prices, and then most notably, input costs for firms. So I'm sure you've all heard of the semiconductor chip shortage going on throughout the world. And interestingly, Ford, when they came out with their earnings release about a month ago now, they had to slash production estimates, even though the demand for autos is so high right now because they can't get the chips necessary to produce these new cars and for consumers. And it's just not that industry. It's a lot of industries, not just in the U.S., across the globe. So given it's a very tight supply chain and the demand is very high, those input costs are rising. So when we think about moving forward, if you look at that bottom chart to the right, one of the interesting surveys that comes out by the NFIB, the National Federation of Independent Businesses, is they ask companies a series of questions each month. And one of those questions you can see there is, are you planning to raise prices or lower prices in the near term? So that black line is showing the difference between the two, and more recently it's ended at its highest level in a decade, meaning that those companies planning to raise prices outweigh those planning to lower them at the highest level in almost a decade. So we have seen inflation come in a little hotter more recently, and it's very likely as we head into Q2 and Q3 now, we could continue to see these inflationary pressures build. So when we circle back to asset allocation in just a few short minutes, keep in mind the discussions we had over really the course of the year from a portfolio construction perspective, right? Trying to have that growth engine in the portfolio to drive the return, at least to the assumed rate of return or potentially higher, but having that insurance as well when equity markets aren't doing poorly or are doing poorly, on the fixed income side, but also having some exposure to assets that are expected to do well if inflation picks up and comes in higher than expectations. So with that said, if you skip ahead to page 9, and again, we'll run a little bit through this a little bit more detailed when we get to the OPEB, given it's a little bit more of a complex portfolio. This is showing asset class performance in Q1 and over the past year. They're the chart to the right. The green bars are the quarterly numbers. You can see U.S. equities at the top there, up 6.3%, so a very strong quarter. Investors continuing to price in an economic recovery and continuing to price in a strong rebound in corporate fundamentals or corporate earnings in sympathy with that recovery. So U.S. equities up 6%. They did outperform international developed and emerging market equities, which were up 4% and 2% respectively. A couple reasons behind that. Excuse me. Number one, the COVID concerns are still more paramount outside the U.S. and international developed economies, places like the UK and Europe still under some quarantine orders. And then in emerging market economies, places like Brazil and India, most notably, have seen a spike in COVID cases more recently. So that certainly weighed on sentiment for those markets relative to the U.S. Now, the real action during the quarter, if you look below emerging market equities, was in the U.S. bond market. So that's a proxy for the Barclays Aggregate Index, which is the benchmark in the investment policy statement. It's an index of investment-grade bonds, think treasuries, mortgage-backed securities, treasury bonds. And with inflation sort of bubbling up to the surface, we saw a big jump in interest rates during the quarter. So we have rates going up, which means bond prices went down. So that negative 3.5% was one of the worst quarterly returns for core fixed income in quite some time. So we'll again keep that in mind when we think about asset allocation. As we talked about previously, the trust is very conservatively invested from a policy perspective, being about 60% equities and 40% fixed income, like those core bonds right there. And as we think about moving forward, trying to grow the trust in a better funded ratio and the lack of any liquidity needs, just by definition, then we can afford to take a little bit more risk because there's not a risk of having to sell something at the wrong time to meet those liquidity needs. So with that said, if you look at page 12, just one other quick comment as it relates to fixed income. So on page 12, up at the top right, we're showing the yield curve for treasury bonds. And as I've mentioned, We did see some movement in rates. So in that darker blue line, those are the most recent interest rates. The dotted line is at the end of the year. You can see not much movement on the short end of the curve since the Fed's still keeping rates at zero, but a big jump in more intermediate and long-term bonds. So that drove the weakness in U.S. bonds during the quarter. Again, rates up, bond prices down. However, that yield curve, that blue line, the more recent one, even though it's increased, those yields are still exceptionally low relative to historical averages. So not only in the short term is the risk reward still sort of tilted to the downside given rates are so low, but in the intermediate term, those rates are going to be the key driver of fixed income returns. So since they're still below average, fixed income outlook still remains very, very much subdued relative to history.
So you see that rate continuing pressure to move it up?
I think it's certainly skewed to have them go higher, just considering the policy support, considering
Yeah, I
the
agree.
economy continues to do quite well. Now, I'm hoping that it's a more gradual rise as opposed to a rapid rise, because we saw sort of a gradual rise in Q1 and equity still did okay. But if we see a more rapid rise, then that could potentially develop into some dislocations in the market. But for right now, the market's expecting a more gradual rise, and we do think that's sort of the base case scenario. So with all that said, are there any other questions about the market environment before we jump into the trust itself?
When you had mentioned the 60/40 that, our portfolio is 60 equities, 40 fixed income, are you suggesting that we change that to be more, and where would you see it changing to?
That is exactly what I'm suggesting, and when we circle into the asset allocation report, all that information will
Okay.
be in there.
Okay.
Yeah.
So, Pat, what about the cyber attacks? How is that impacting the markets at this point?
Right now, the market seems to be just sort of not reacting all that much to them. Obviously, we've seen a number of them more recently between the Colonial Pipeline and just the other day with, I think it was JBS was the name of the
Right.
Oh,
company.
you're talking about the hacking that's going on?
Yeah.
So they came back online. Right now, the market is looking through that because those things came on or came back on relatively quickly. But if we see an uptick in these sorts of things, which seems like the direction that we're heading, in theory, there could be an increase in, say, concern about those sorts of things. So that could eventually impact markets, investors being more concerned about the frequency at which that happens. But as we stand here today, they sort of look through those issues.
I think if anything bothers me, if that's not a good term, anything concerns me is the amount of borrowing the federal government's doing. And at some point in time, this $6 trillion, whatever, this astronomical sums, is going to have to start being paid back. Now, of course, they did talk about how the rates are so low, now's the time to borrow, but these are heavy, heavy numbers. And, I wonder if at some point in time, the real economy reappears, i.e. the stimulus money goes away, the unemployment benefits go away, those types of things go away, and what's the economy look like? And my point gets to be, is I think it's going to be slower. I think it's going to be subdued. So, I don't know, that's my crystal ball, and who knows if it's...
Oh, I think you're spot on. I mean, just about how things work, right? The stimulus is so front-loaded, right, that when we looked at those estimates for the rest of this year, they're well above average. But then the marginal contribution or effect from the remaining stimulus weakens over time. So I talked about how strong economic growth is going to be this year. It's not going to look anything like that next year unless we get even more huge packages coming out of Washington.
Well, you talk about commodities and equities. Because we were locked down for so long, we've seen people say, hey, look, I'm going to do some improvements to my home, or I'm going to do something. They're not traveling. The hotel industry's, the travel people are taking a real hit. And I guess my point gets to be is that that's going to go away too, is that people, we're going to hopefully return back to normal, whatever that term is. And I wonder if we're going to have the consumer spending that we're having now that's growing those equities and commodities. Again, I'm a little cautious on this portfolio going forward. I still like to remain conservative.
Yeah, I think, Commissioner, you raise a good point. That what the feds are trying to do right now is like bridge the gap, right? Provide bridge financing, right, from where we fell off the precipice about a year ago, and provide the support to the consumers and businesses to help bridge that gap to when the private sector can stand on its own 2 feet. We're not there yet. The employment report for May came out this morning, and it showed about 700,000 jobs added, which certainly sounds like a lot, but that was below.
Must be over 1 million, right?
It was well below the estimate. So we're still seeing an improving labor market, but not nearly as much as I think some of us had hoped for. So the length of time or the length of this bridge to bridge that gap seems to be getting extended a little further and a little further. So if that's the case, then we could see some more support coming out of Washington to help, get us to the other side. But if we don't, to your point, then I think economic growth is going to decelerate rather notably next year. And that could have implication for markets. But the markets these days are really driven by policy, what's coming out of Washington and the headlines around that. So it remains difficult not knowing how that's going to unfold in 6, 9 to 12 months to really make a, fully informed estimate of what the economic outlook could look like until we see that.
I guess my point is we're dealing with money that we cannot afford to lose or we don't want to lose, and so we
Sure.
keep some kind of a conservative or some kind of a cautious approach. But again, we'll hear you out. I read your stuff, so I'm just
All
kinda
right.
prepping you up for the end.
Well, I appreciate that. So if we can hop behind Exhibit 3, we'll talk about the trust results themselves. So on page 18 there, we always just provide a high-level observation of the things that we're going to discuss, really the high-level takeaways. So in that first bullet point, you see the observations there. The trust at the end of March was about $5.9 million. We have an updated asset value to share with you all shortly in the next book. You can see the investment gain was about $162,000, and the portfolio as a whole returned 2.8% net of fees versus the policy index per the investment policy statement of 2.3, so outperformed by about a 0.5 percentage point. So when we think about what drove that difference or what helped the portfolio outperform, that's when we get into attribution. So that's what's explaining the difference. So on the positive side, that's what was helpful. Number one, an equity overweight. So if you recall, when we met in February, we talked about how conservative the trust was and didn't recommend any rebalancing at that point. We thought equities were still sort of the place to be in the short term. So that was helpful, being overweight equities relative to policy, having more money in equities relative to your target. And the second big thing was the U.S. equity structure. So if you remember back in February, we took a deep dive in basically how the pieces fit together, right, on the equity side and the fixed income side for all the portfolios. So what we saw in Q1 was those more cyclical or economically sensitive areas like small caps and mid caps outperform. So within the U.S. equity structure for the portfolio, having a little bit more in those two areas within U.S. equities relative to large caps, that helped out performance because small and mid caps did better than the broader market. On the negative side, really nothing to report given the straightforward structure, asset allocation, implementation. Only a couple things are going to impact relative performance, namely those two that were helpful during the current quarter. And then looking ahead, we'll do the asset allocation study shortly and then talk about the investment policy statement at a subsequent meeting. So if you focus on page 19, this is the executive summary page. So if we had 30 seconds at a meeting and said, Pat, 30 seconds, give us the high-level overview here, this is the page we'd focus on. So if you focus on the top, it tells us the summary of cash flows, essentially where we were and how did we get to where we are now. So at the first quarter, you can see we began the year at about $5.725 million. There were no flows in and out of the trust. And then you can see that investment gain of $161,000. If you compare that to the fiscal year to date, we began with about $4.133 million. There was the contribution last year, some withdrawals for fees and expenses, and then the investment gain at the bottom. So all told, the trust itself grew by about $1.55 million in the current fiscal year. If you look at the returns in the middle, we'll skip over this. We'll spend more time talking about these when we look at the peer rankings page in just a minute. But if you focus on the bottom chart, the asset allocation versus the targets, the key takeaway again here, if you focus on those first 3 rows, where it's showing the current allocation, the U.S., non-U.S., and emerging markets respectively, they are each slightly above their target. So we went into the quarter with about a 2 percentage point overweight to equities, which, similar to Q1, has so far proven helpful, as equities are up about 5 to 6% here as we stand through the end of really yesterday. So having more money in equities, just like in Q1, has been helpful so far here in Q2. So if you skip ahead to the next couple pages, I'll walk through these quickly.
What about this fixed income? We took a hit on that, baby. The 161 negative?
So the Commissioner, that is showing not the investment gain, but the difference relative to the policy. So
Oh, okay, so that's the 41 versus 38.3?
Yeah.
Oh, good, thank you.
yes, sir.
Go ahead.
So essentially, that would be the rebalancing required to move everything in line back
Move
to
it back.
target. Yes. So if you look at page 20, up at the top here quickly, it just shows the market value history, how that's changed over time. So obviously, if you look at the top right there, you can see the trust has ended the quarter at its highest level since it was first funded a few years ago. But if you look at the bottom of the page, I just want to spend a quick minute on this. So again, breaking things down at a more granular level. So we showed the cash flows at the total portfolio, but here we're breaking it down by individual manager. And if you look at that second column, you see net cash flows, and it might be counterintuitive at first glance because nothing was approved, cash didn't move in and out of the portfolio. But what happens here for ETF vehicles, they don't automatically invest their dividends like mutual funds. There's really no option to do that. So once they pay a dividend, it's just moved directly into cash. So that's why there's negative cash coming out of all the ETFs. And then in that second to last line, you can see about $15,000 in aggregate moving into cash. So when we get to the recommendations, a couple short minutes, we'll talk about putting some of that cash back to work as it's been built up over the past quarter. On page 21, again, just getting a little bit more granular, you can see at the top, it's showing the asset allocation over time with the legend to the right showing the respective asset classes. And you can see a couple of those big lighter blue bumps over the past 2 years. That's really the contribution, right? So the annual contribution going in, it's sitting in cash for a little bit before it gets fully invested. That's why you see those big bumps in a couple of years there. As far as the bottom of the page, this is again just the same information that we talked about a little bit earlier, but it's showing the allocations to the respective managers themselves in the first 2 columns. So again, a more granular breakdown of the asset allocation across each individual asset class. So if we move ahead to page 22, this is the peer rankings page. So I think we talked about this before. We use the same third-party platform as the previous advisor called Investment Metrics. So it's a third-party platform. We use it, maybe about 50 other consultants use it. So there's trillions and trillions of dollars on this platform. It gives us an opportunity to really slice and dice this data on an anonymized basis. So what we're doing here is comparing the trust results relative to public defined benefit funds across the U.S. And there's a ton of charts and data on this page. So if you just focus on the bottom 2 rows, this is where the big takeaways are, where you see the circle and the triangle. So as you work your way from left to right there, you can see again that 2.8% return I mentioned a few minutes ago, this is net of fees, was good for 66th percentile. So lower numbers here are better. So that's indicative of below the median. When you look at the policy index at 2.3, that was almost in the bottom quartile. And just to echo some of the comments I made earlier meetings and more recently, being a little bit more conservative, if you just focus on that policy index, right, that's your strategic asset allocation, and work your way from left to right, you can see generally in the bottom quartile or below the median. So what that's telling us is that the trust itself is much more conservatively invested than many similar funds at a time when the total portfolios, you can see all the way to the right there, returned about 8 or 9% respectively. So it's been a very good environment for markets, but having that little bit more of a conservative allocation really explains the difference between how the trust is doing relative to other public defined benefit funds. So again, want to keep that in the back of our minds when we shift gears to asset allocation in just a few short minutes. Questions about that data before we continue on, or anything else?
Now, we would have had a more conservative approach early on in the funding into this thing because we didn't have a lot in it to kind of self-fund. I'll let you continue on. I'm still thinking. I'm not ready to speak yet.
Okay. And I think a lot of this discussion will help be fleshed out when we shift gears in the asset allocation as well.
Right.
Page 23, just quickly, it's the same data, but we just show it for fiscal years. So obviously, we only have 2 fiscal years so far. We'll have a third for the next report, but it's the same universe and the same data just for those different time periods.
Underperform.
If you skip page 24, this is just a higher level look at the risk of the portfolio relative to the benchmark, but since it's so new, we only have 3 years of data. We put it in here because it's a staple, but it's not all that meaningful right now, given the trust has only been around for 3 years. I'll talk more about it when we switch gears to the OPEB report. When we look on page 25 here, so now we're breaking down not just the returns of the total fund you see at the top, but then each respective asset class in those darker gray bars, and then the individual managers within those asset classes in the lighter gray bars. So we talked about the total fund returns, but if you look at the U.S. equity composite and work your way to that first column there, it was up 8% during the quarter relative to the benchmark of about 7%. So as I spoke about earlier on, what really drove that is if you work your way down the page, you can see the S&P, or the Vanguard S&P mid-cap ETF was up about 13.5%. The small cap ETF up about 18.5%. So just as an accounting identity, we can know that having more allocation to those areas drove the outperformance because we're just using passive funds. So that's the only explanation. So as we think about that, having more allocated to those areas, which was helpful really at the early stages of an economic recovery, and we talk about the recommendations later on with the expectation that the economy may decelerate moving forward, we think a more balanced approach between small, mid, and large caps makes a lot of sense. For the rest of this page and the next page, not really too much to cover here. These managers are all passive managers. Their returns will be largely in line with the benchmark at very low cost, which we'll look at in just a second here. But any questions about the returns themselves before we move forward? Okay. So we want to shift gears to page 28, please, as we round out. So one of the things that we always include in our reports, and I don't know that it's something the committee has seen before, is fees for all the managers. So in the interest of transparency and disclosure and for the committee's own comfort and knowledge, what we're showing here is all of the investments, their fee schedule in the second column, how much of the portfolio they have, what it's estimated from a dollar perspective, and then the estimated annual fee all the way to the right. But if you look at that blue line below, that's the aggregate number for the total portfolio. So all the way to the right in the blue line, the expense ratio for the portfolio is just 6 basis points. So very, very low cost, very, very cheap. And we talked about the importance of that given the small asset base of the trust. We think maintaining this passive approach as the trust grows continues to make a heck of a lot of sense for the fact that keeping fees low just means dollars stay in the trust, they compound over time. And secondly, we really can't access institutional type quality managers at a good fee until we're maybe double this level or closer to $15 million. So when we do get there, we'll revisit implementation. But for right now, low cost, passive approach, definitely agree is the way to go.
But you get what you pay for.
We'll see that with the OPEB shortly. Any other comments? That wraps up everything I had for the book. The rest of the sections, again, are just more of a breakdown of the asset classes and the managers themselves as far as characteristics and exposures. And again, it's relatively straightforward for the LoSAP, given everything is a passive investment. So happy to get into any of that information, but for right now, that was going to wrap up my comments as it relates to the report.
Anybody? No. Thank you.
So do you need a motion to accept the report?
Go ahead.
Looks like there is. So I'll make a motion to accept the Marquette Associates Portfolio Update, quarter ending March 31st, 2021.
Second.
First and a second, all in favor?
Aye.
Aye. Motion carries. Next, we're going to get into your recommendations.
Yes, so
That's
this
the second book.
Yes,
Yeah, that was the one I was on already.
the second book indeed.
Got to that one early.
All right, terrific. Well, thank you again. And if you hop behind the cover page in that book there, and you see the table of contents again, as outlined in the agenda, we'll start with the recommendations. That'll be in relative short order, and then we'll shift gears to the asset allocation study. So if you flip behind Exhibit 1 there for the recommendations, you can see on page 4, this should be relatively familiar for most of you all, how we show the fund allocations broken down, not just at the total level, but at each individual manager. So a few takeaways on this page before we get into the recommendations themselves. So you can see in the, call it second column from the left there, the total assets of the trust at $6.11 million through pretty much the end of May. So at the end of March, it was 589. So far in Q2, the return's been just a shade under 4%. Again, as I mentioned, equities have continued to do well. So a strong start to the quarter. And if we think about the fiscal year to date so far through really the end of last month, we showed about 16% or 16.2% through March. So with 3.8 on top of that, now we're looking at about 20.5%. So well north of that 6% bogey. And you should see the positive impacts of that. You know, we have a few weeks left here, but we're comfortably ahead of that. And hopefully we'll stay that way in the next actuarial valuation report. Actually, I'm not terribly sure. Is that done annually or semi-annually?
Semi-annual.
Oh, okay.
Semi-annual.
Semi. So are we looking at the next one for this year, or will it be the year after that?
We just had one, didn't we?
I think we just had one.
I think, yeah.
The year after that, okay. So if we think about it, you know, for 2 years forward, if we finish, call it 20%, then that means in the next fiscal year, we're 14% ahead of the actuarial assumed rate of return this year. In theory, for the next fiscal year, if we had a negative 10%, we'd still be in line with that actuarial assumed rate of return over the 2-year period. So we have a lot of cushion build up in this year, and hopefully, again, we have another decent solid year the following year, and then at that point, we'll see the positive implications for the actuarial valuation report when it's done at that time.
Yeah, we're actually doing a RFP for another, what's the term?
Actuarial.
Actuary. But we're just trying to find out about the rates. But I would be interested to know what other actuarial opinions are. We've had the same guy for a long time, and I like him. Nice guy. But I would like to get another opinion. All right. Go ahead.
So a couple key takeaways when we look at the recommendations here. If I could bring your attention to the bottom left chart, the smaller chart on the page. So similar to the report, what we're showing here in black is the current allocations across the respective asset classes. In blue are the targets per the IPS. And then the difference, if it's in green, it's overweight, and in red and underweight. So you can see between the 3 equity segments, we're about a 2.5 percentage point overweight in equities as we stand here today, about a 0.5 percentage point overweight in REITs, and that is largely being sourced from fixed income, most notably investment grade, which is a proxy for that -3, 4% return we saw earlier. and the high yield. And you can see cash has been further built up over time, so we're about a percentage point overweight and about $51,000 in cash in total as those ETF dividends get thrown off and put into cash. So 2 recommendations for the committee consider. One is structure related, and the other one is related to putting cash to work. So if you look at that middle column in rebalancing, the first recommendation is to move $50,000 out of the Vanguard Small Cap S&P 600 ETF into that Schwab US Large Cap ETF. So again, a little bit more balance. So those small mid-cap companies did exceptionally well in Q1, given economic activity continued to run pretty hot. But as things sort of even out over time, the performance based on history should level out. So basically it's selling high and buying low, with rebalancing, just within equities. So not taking any equities off the table, but sort of taking a more balanced approach to the structure itself. The second recommendation, if you work your way all the way down to that middle column, would be simply using $25,000 in cash and moving that into the iShares Broad USD High Yield Corporate Bond ETF. So these are obviously high yield bonds, as I showed on the chart a few minutes ago. Even though core bonds were down 3.5%, these bonds were up about 1%. So they're not nearly as impacted as interest rates, and the yield on these bonds are somewhere in the neighborhood of about 4.25%, whereas the core fixed income, it's about 1.5%. So not only is the yield lower, but those core bonds much more sensitive to interest rate changes. So putting some of that cash to work, I think, not necessarily in equities because we have a decent overweight, but maybe in the U.S. high yield market makes some sense.
Yeah.
So on page 5 there, you can see the recommended actions for the committee as summarized on the previous page and as listed below there. Again, moving 50 grand into Schwab US Large Cap coming from the Vanguard Small Cap, and then $25,000 to that USD High Yield ETF from cash. So let me pause there for a second for any questions or comments.
I guess my question is, I understand that the equity is supposed to be 30% of our portfolio, right? That's the target. And so within that, you have the 3, the large, mid, and small. Within those 3, is there a specific target for what each one of those 3 makes up?
For each one of the 3?
Right.
So it is
Towards the 30, is that?
Yes, so it's 24% to large caps and 6% to the other 2. So if you look at the allocations, to my point earlier on, moving those funds out of small caps will bring that into more balance. So it doesn't look exactly like 24 and 6 because we have an overweight, right, of 32.
Gotcha.
But proportionally, having more money in the smaller and mid areas would be a greater overweight than having more money in large, given those targets.
Okay, I was just curious what that was. Thanks.
You're welcome.
I think all these will grow, given the current economic outlook, but I do like the small cap over the large cap.
And we'll still have that tilt, if you will. It'll just be mitigated slightly.
Well, it seems like Vanguard's doing a little bit better in stuff I was reading last night.
No, Commissioner, certainly more recently in Q1, small caps have outperformed. Now in Q2, that's leveled off to some degree. There hasn't been too much differentiation between the returns.
What do you think in 3 and 4? What's the outlook?
For 3 and 4 years?
Yeah.
Well, hopefully equities.
Quarter,
quarter.
I'm sorry. Quarter.
The third and fourth quarter?
The rest of this year.
The rest of this year. I think that, again, at least, we use history as a guide, and when the economy continues to decelerate or move more into, say, like a mid-cycle type of outlook instead of early cycle, then this performance tends to level out and there's not much differentiation. So I think moving money into large caps is kind of splitting the baby, if you will,
Okay.
bringing the structure a little closer, but we still have a little bit tilt to those other areas in small and mid caps.
So I might want to make a motion now.
I'm going to make a motion that the committee approve the proposed rebalancing of $50,000 to Schwab U.S. Large cap ETFs to Vanguard small cap. Oh, I'm sorry, am I doing that the wrong way? No, I'm doing it the right way.
It's coming from Vanguard.
It's coming from Vanguard and going to Schwab, and then moving 25,000 in cash to 25,000 iShares Broad USD high yield corporate bond.
Is there a second?
Second.
Is there any discussion? Excuse me. Okay, if not, all in favor?
Aye.
Aye. Ayes have it. Thank you.
Okay. So we're going to move to the next item on the agenda. Do we need to do an approval of that like we just did for the quarterly report before?
I think we just did it, didn't we?
Yeah.
Oh, you did?
I made the motion.
Oh, I apologize.
Oh, no worries. No worries.
But we're moving it around.
So I know at one of our first meetings, I just got in the zone and I powered through everything and didn't
Right,
necessarily was cognizant of the agenda. So we'll round out here with our final part of the presentation in the next tab, the asset allocation study. So I think this will help answer some of the questions that came up during the report. But think about this as a tool to aid the committee to developing that long-term roadmap from an asset allocation perspective. So even though it's strategic, think long-term, it's something that we'll review on an annual basis because the capital markets environment can change pretty rapidly, as we saw Q1 of last year and really over the past year with a strong equity return. So this is a good exercise to make sure that the asset allocation is in line not just with the assumed rate of return, but also takes into account the unique characteristics of the trust, right? Namely that there are no liquidity needs, right? So we can afford to take a little bit more risk perhaps than what we are now. Again, just don't have to sell things at the wrong time to meet benefit payments or expenses. But when we walk through these numbers, I would like to think about this more as not just a trade-off between the various portfolios, but also directionally for the numbers themselves, because we put in numbers here that are out to 2 basis points in some instances, and I guarantee if we're sitting here in 10 years, it's not going to unfold to 2 basis points. We don't have that level of precision. But directionally is the most important. Again, the trade-offs, the upside versus the downside, things of that nature are the most important takeaways when we look at these portfolios. So with that said, if we look at page 7 here, one of the things that we like to do before jumping in is, in the interest of transparency, again, what are we assuming for these asset classes over the next 10 years? You can see in that second column, but then also for more context, what are other consultants, other parties looking at as well? Okay, just for more context for the committee. So that third party 10-year is an aggregate, an average of about 40 consulting firms that an actuarial firm puts out about once a year. So there's a couple takeaways on this page. Number one, if you simply look at the equities in U.S., non-U.S., and emerging, the first thing is, us and our peers are certainly expecting below average returns from equity markets over the next 10 years, and that's mainly the result of valuations. So like we talked about previously, valuations are a little bit more expensive now than history, and what history tells us, if you buy something that's a little bit more expensive, then your return from that point is likely to be below average, and vice versa. But right now, things are a little bit expensive. The other key takeaways, if you look at infrastructure and REITs, this really gets back to our discussions over having that inflation insurance in the portfolio. So REITs play that role, TIPS play that role, infrastructure plays that role. And importantly, even though we're looking at infrastructure as an asset class, you can implement that using a passive ETF. They are out there. So adding that diversification won't compromise the implementation side of what we're trying to do and keep things at a low cost. So if the committee ultimately would like to include it, we can still do it and keep us on the path that we're using right now. So if you look at page 8, the rest of these pages are going to show you the output for these 3 portfolio options here. So the first one, the current, these are the respective allocations for the current asset classes in the IPS. And then number 2 in the middle there, it says lower FI, that's lower fixed income. And number 3, lower FIV2, lowering fixed income a little bit more. The other key takeaway, obviously, if fixed income goes lower, the money has to go somewhere. So that would be in equities. When you look at U.S. equities and non-U.S., in aggregate right now, you only have about 51% in equities. In the second and third options, respectively, it's 55 and 60. So still a pretty conservative type portfolio there. A large portion still in fixed income, but increasing that equities, trying to increase the return expectations. And then finally, below, you'll see in the current, REITs have about 8%. We would expect them to continue to do well if the economy continues to improve, but the outlook, like we talked about, is still a little murky, still a little cloudy. So the recommendation would be to complement that with listed infrastructure, to play a similar role in the portfolio, but the latter doesn't necessarily suffer from the same sort of structural headwinds, like the office market and real estate, like the retail market and real estate from the Amazon effect for the latter. So with that in mind, if you hop to page 9 again, we'll look at a base case outlook here and then talk about all the trade-offs between these two options. So on page 9, the key takeaway there, summarized with the brief blurb, higher allocation to equities will increase the likelihood of meeting the assumed rate of return. Very intuitive and straightforward. You're going to move money out of fixed income and increase the equity exposure. You could expect higher returns. And that's illustrated in the table in the middle. That's showing the base case 10-year outlook you can see for the current, and pretty much at the assumed rate of return of about 6%. The second one, lowering fixed income by about 5 percentage points, increases that by about 20 basis points annualized to 6.2. And then finally, overweight to the right there, about 6.5%. So still well above the assumed rate of return all the way to the right there. Now that's the base case scenario. And before we switch gears, if you look at the volatility below those returns in that top table, moving money out of core fixed income, even though the return outlook is not great by any stretch of the imagination, it's still a very conservative asset class. So when you move money out of something that's very conservative into an area like equities where you expect a much higher return, but there's more volatility. So at the total portfolio level, you can see compared to the current, the volatility or the risk would step up in lockstep with that as well. Questions about any of that, because then we're going to shift gears and start looking at the trade-offs from a returns, market value, and funded ratio perspective.
I guess this is what got my attention is when I saw this higher volatility, again, higher return, higher risk, higher volatility of risk, and I just want to maintain a conservative, but I want to be smart about it. I think I told you earlier, we're getting ready to put some money into this thing, and we want to look at it.
Well, that's an important. I'm sorry to interrupt. I think
No,
we were gonna say-
no, please.
I was just going to say, Commissioner, not that this is the same as the OPEB, but think about the OPEB as well, where it was very low funded early on when you begin it, and it was much more aggressively implemented over time, and that's paid off.
Yes.
Right.
But it was timing, too.
You are 100% right on that, absolutely. But when we think about the OPEB too, the proposal here relative to what the OPEB was is still much more conservative relative to that.
I totally agree, but I just think the core amount in it is low. It's so low. So that's why I think that we want to, a hit on this is worse than a hit in
Right.
OPEB.
I would say, I don't know about that. So
Okay.
think about it. I always think about risk. I mean, it means so many different things to so many different people, but, and please correct me if I'm wrong, but from the county's perspective, right, the unfunded liability for the LoSAP is so great that the returns are not going to impact that contribution very much. Just think about the contributions the county has to make. It's essentially a mortgage, right?
We get it. But I'm also about, I'm sorry, you guys get it, right?
I do understand, and I guess I always, I'm the newcomer here. I try to wrap my head around this discussion thinking of, a person investing for their retirement, right? Which is essentially what we're doing in a way. And I guess what you're saying now is this fund, we're sort of a young person that can bear more risk because we're not paying out that. Is that
Right.
Is that a correct way to look at it? I mean, that's.
Yes, and related to that,
Right.
a young person doesn't have any
Can take more
spending,
risk.
spending, and right, because they don't have spending needs and they have the
They got
long term.
longer to recover.
Right.
Now, you
Yeah.
know, old guy here, and my sense of it
No,
continues.
no comment.
Well, look, it is what it is. I got 30 years on you. My point gets to be is that we're still dealing with other people's money. It's a fiduciary responsibility that I need to make sure that, you know, I'm true to myself and I continue my conservative, what I can call conservative ways. So going forward, I see your point. I believe if we get a bigger fund, it can have better returns. And like OPEB and SORP, it can kind of start self-generating. I mean, the returns have been self-generating, which has been great. But I also say this is, you know, I sit around and claim that, you know, while I've been on this board, you know, these things have gone up, but look at the economy. But the other thing could be is if, you know, we had a big downturn in things, and I don't know, I'm just concerned
Sure.
that we get too aggressive.
It's interesting to me, though, the third line, because you're averaging the return with the volatility. So
Yeah.
it's even it's lower in the proposals.
Just
Right, and that's the nature of
Right.
taking money out of fixed and adding it to equities. So you get a higher return, but your risk increases a little higher proportionally.
But in average, it's decreasing
Right.
because of the higher return.
Because of the higher volatility relative to the return. So your denominator is going up proportionally higher than the numerator there, if I'm making sense. So when you look at just the current versus the lower fixed, you have a 20 basis point increase, which I'm trying to think about it from a percentage point perspective, might be about 3% or so. But from a risk perspective, the 9.7 to the 10.5, that might be 8% or so. So when your numerator goes up by 3 and your denominator up by more than that, then your average return
Lowers your
divided by the volatility will come down. Those are still very high numbers, and at the end of the day, it's really, you know, it's all about trade-offs.
it's kind of like comfort level.
Exactly. So if the committee is more comfortable with a more conservative portfolio, then, you know, that makes a lot of sense. But at the same time, just have to realize the implications of that, right? If we just meet the assumed rate of return, then the contributions are going to be what they are. If we can come in a little bit higher than that, then the contributions will come down a little bit on a relative basis to what they are. But it's all, you know, you got to take it into account of the entire budget itself, right? But my comments, just quickly circling back to the OPEB, Commissioner, a poor return in this fund from the county's perspective will have a much lower impact than the OPEB because the unfunded liability is so big in this one. Whereas on the OPEB, the mortgage you're paying off is so small, right? That contribution is coming from the normal cost. In other words, the benefits being accrued each year. So the returns would have a much bigger impact for OPEB from the contribution than the LoSAP.
You know, sometimes I do that. I get things flipped around in my mind and I get on the wrong track. All right, I see what you're saying.
And then from a dollar perspective too, right? The contributions here are what, a million-ish dollars?
This year, it's going to be 2.
It's going to be
Well, this year it's 3-2, right?
3.2
3.2.
starting in July, right?
But that's in addition to what the actuary is requiring, I think, right?
That's the amount that's going to the actual trust, right? And that doesn't include the PAYGO amount for the current retirees.
Right, but maybe I'm misspeaking, but what Bolden is saying that you should be putting in is less than what you're going to put in.
Yes.
Yeah.
Right.
Yes.
So my perspective is just what Bolton is saying you have to put in, right, is only $1 million or $1.2 million, whatever that number is. So the returns won't impact that number so much because the funded ratio are so low,
Right.
right?
Again, the key is to get that up,
Right. The funded ratio.
Right, which,
but also make sure it's not real high risk.
yeah, so you do that through two levers, right? The increase in contributions, which sounds like it's going to happen, or higher investment returns. But if you're doing the former, then maybe you don't have a need to do the latter.
Well, that's another discussion about turf fields, but we'll talk.
So with that in mind, let me walk through some of these other pages quickly, and maybe it'll help us frame up the path forward. So if you look at page 10, again, just to reiterate my comments about trade-offs, this is showing the distribution of the returns themselves. So we showed that base case on the previous page. You see that at the top line there where you see the average and the median, but then the distributions below that. So the 5th and 25th percentiles, that's sort of worst case type scenarios, the 5th being a very, very worst case scenario. And then the 50th, 75th, and 95th, that's sort of your base or upside scenarios. So think about this as similar base case, similar upside, but admittedly a lower floor, if you will. You can look at the current in that 5th percentile just at about 0.6%, the first version 0.3, and the latter version 0.1. So adding more in equities relative to fixed income will, be more volatile and give you more volatility on the downside. But again, the trade-off of a better base case and higher upside type of scenario. If you look on page 11, the story as we continue through these are going to be pretty much the same when you have higher return expectations. This is the market value distribution of potential outcomes over the next 10 years. We did work with Bolton to incorporate their projected cash flows here. And you can see those diamonds in the middle of those distributions are reflective of the base case. So again, higher market values over the next 10 years, assuming the investment returns and the cash goes into the funds, but wider distributions, right? Again, taking more money out of fixed income, adding it to equities would lead to a wider or more uncertain outlook over the next 10 years. If you look on page 12, again, for the funding ratio summary at the end of 10 years, again, we work with Bolton to get the cash flows and the liabilities, but it's a similar story when we think about returns and market values. In the middle of that page, the base case scenario, at the end of the next 10 years, the trust could be, very, very well funded. If markets continue to deliver and the contributions go in. Again, you have that higher upside potential, but from a funded ratio perspective, a little bit lower on the downside when you look at that 5th and 10th percentile. So again, all about the trade-offs, the comfort level of the committee, and really thinking about certain budgetary implications if appropriate to consider as well. So the last few pages on page 13, 14, and 15, when we think about a worst case scenario over a 10-year period, typically market poor environments aren't 10 years. They're a few months, a year, 2 years at most. So what we do here, I think is pretty interesting, is we look at these current mixes and then we say, well, what would things have looked like at the 2008 financial crisis? In other words, if the portfolios were allocated like these potential mixes, how would the market values have changed at the beginning and then subsequent to that crisis? So the takeaway, if you look at 2024 in that top right table, obviously moving money out of fixed income and into equities right before a downturn is going to leave you with less money, just intuitively. At the same time, if you look on page 14, we not only look at it from an equity perspective, but an interest rate perspective too. So what happens if rates spiked, similar to what happened in 1981? Well, now you'd be a little bit better off because having less fixed income in the portfolio would leave you less sensitive to interest rate changes over time. And kind of pulling those ideas together on page 15, one of the things that we can look at is, hey, well, what if equities do poorly and interest rates go up? It's not an environment that we've seen in quite a long time, but it's not out of the realm of possibilities. But at the end of the period, you're basically left at the same position, right? Because lowering fixed income is going to hurt you if equities do poorly, but lowering fixed income is going to help you if rates go up. So you can see that 7.8, 7.8, 7.7, pretty much the same outcome if equities do poorly over a 3-year period and rates increase over that 3-year period as well. So to wrap up this discussion on page 16 here, what I'm again just showing are these potential options and then the base case outlook there on the bottom. So I think it's my hope here today for one of two things, either to, maybe come to a consensus about the path forward with these allocations. If not, we'd be happy to run, another set of iterations for the next meeting and walk through those. But then in conjunction with that, also develop an investment policy statement draft so we can continue to get the ball rolling and moving forward. But with all that said, let me pause for any further comments or questions from the committee.
I mean, I'm happy or I'm satisfied. I don't know about happy, satisfied with the way it's growing. I think it's a little slow, but it's also the nature of this. So the policy statement, I think, is a great idea. I just worry that we're ripe for a correction, and, I've had my share of buying high and selling low. So I'm sorry, I'm rambling here. Go ahead. Anybody else?
I think it's reasonable to think we're going to face inflation.
I do too. Higher interest rates.
Yeah.
When's the turnaround? Was it 3 to 4% when the market goes down because rates go up?
For rates,
It's about 3%, 4%?
historically, if you look at that data, that's exactly the level, at least 3 or 4%, but also very important, not just the level, but the rate of change of how we get there. So if we have a huge spike in rates, that would be much more detrimental to, say, this sort of gradual increase that the economy and, the markets can sort of digest over time. But you're spot on, that 3.5–4% level is where sort of the script flips there.
I mean, we hear the Fed's, they're going to relax that policy of bond buying or whatever they do when they buy all those bonds. And that just, again, leads to me to think increase in inflation, increase in interest rates.
Right. So that lower FI might position us
Yeah,
to buffer inflation better.
right.
Right, because that lowers the fixed income and then
Right.
incorporates some of those other inflation-sensitive
And
assets.
possibly that the first one is just a little bit more conservative than the second, which might.
Absolutely.
But not as
But not
aggressive.
as risky as
Right, so this might be more comfortable
The middle
for the
ground.
board.
Yeah.
I like the lower, I guess, FI,
Fixed income.
fixed
yeah.
income. And in terms of, because when we look at the equities that we invest in, it seems like they're mostly, index funds that in my limited experience don't seem to take the huge swings. But I haven't, been around for, obviously I wasn't around for the 87 and things like that. But, so I'm comfortable with the middle road again for the hedge against what
Yeah.
they were
I
discussing.
think
And I am too,
Yeah.
yes. The middle.
I'm very comfortable with the middle. I would have been even comfortable going the other because of the fact that we have such a long period to
We
grow
do.
this fund.
Young fund.
Yes, it's such a young fund, but I'm comfortable with the lower also.
and I think we're in agreement on that. I think the thing to, at least I want to keep in mind, is that it looks like this federal tax cut of 2017 is giving us more revenues coming in. Now, we had the best of both worlds, in my opinion. Of course, people have different opinions. This year, where we were able to raise salaries, but also lower taxes. That's a interesting dynamic to do. And going forth, if these income taxes continue to where they are, we're going to be in my opinion, in a new position into this year, like when we do our audits in December, that we may be able to do a mid-year correction with this, with money.
Looking and see.
And the
Yeah.
key gets to be is pump it in while we can, but don't pump it in high. So I guess I'm fine with the lower one, and you're thinking the lower of the L2?
I think everybody thought
No,
that.
I
think we
said
all-
I'm comfortable with the middle.
The middle,
But
yeah.
this is put in gradually. I mean, this is a strategic placement going from these allocations.
Right, so we wouldn't necessarily look for any approval or motion here today. What we'll do is incorporate this into the investment policy statement draft, put an effective date, and then stage it in.
But
Right.
Well, my thought is, so if we give you 3.2 to put into it, we want to see how it's allocated, and hopefully, I'm sure you're going in this way. But, there's potential come around the end of the year, first part of next year, to be another pot of money, if I can talk to other people can go in with me, and to,
Yeah.
again, reinforcing this fund and getting it up to a point where it's more attractive and self-funds.
Well, in a perfect world, all the money goes in, we have a great fiscal '22, and like I said, we revisit this on an annual basis, and if we're at a much higher funded level ratio, not just the markets, but the characteristics of the fund itself. So if we're at that point, maybe we're take a step back and say, wow, we're a heck of a lot better funded than we thought we would be just a year ago. Let's revisit this, and we can have the discussion and change it as appropriate.
So what needs to happen to do this? Do we have to change the plan itself? Do we have to,
I would,
The investment
investment
policy.
policy statement?
yeah, now but you're working on that, right?
Yep, and that would be the next meeting.
And that'll be in
Next
the
meeting.
August
Okay.
meeting?
Yep.
You'll bring that back?
Now, do we want to have an earlier meeting? I know we've been having these things monthly, but we've been breaking in the new guy here, and
Right. I think we have the quarterly meetings
August, it's not till
in
August
August.
27th.
Right.
we're good for that, you think?
I think so.
Well, I think Pat suggested earlier that we might want to meet sooner because of the new investment.
Right, and the new investment policy, but.
Right.
Right, if the contribution, what would be the timing of that?
It would
See,
be
the thing
in
is, we got a lot
July.
we got a lot of time off over the next couple of months, I know.
Right. But we would actually send that money from finance. We could probably send that as soon as July 1st comes. We can plan to send that at the beginning of the fiscal year.
Okay.
So we have a SORT meeting July 22nd. I don't know if anybody would want to try to incorporate a special LoSAP or OPEB meeting, because we'll likely be in the same position with OPEB, right?
Right.
Correct.
I'm on vacation that week, but
Okay.
just to let you know.
We can dial you in.
Yeah, don't do that, don't do that.
I know.
Not on your vacation.
Don't bore yourself.
No.
I mean, I'm good with that, just because I kind of want to monitor this slowly and probably a little bit more closely as we go along. But
Sure.
I think so, yeah.
It's up to the board, yeah.
you're not doing it?
I mean, I don't have a problem, but I mean, I'm thinking, keeping to the regular quarterly schedule, I think
Oh,
is
yeah.
fine too.
But I think just because we brought them on and we're starting to fund this a little bit differently than we have
Right.
in the past, at least for this board member, I'd like to keep a little bit better eye on it.
Okay.
Well, what do you think, Mr. Wenger? Do you think,
I think if
July would be good for us?
If the committee is okay with another meeting, July would work to keep us on the same track as the OPEB and the SORP. And I think eventually, once we get these things in place as far as the new investment policy, some of the upcoming changes with the contributions, then we can scale that back a
We're
bit.
not doing OPEB in July, are we?
Well,
I don't know. I mean, we might want to think about it after that
Do
presentation.
the whole thing at one time again?
Currently, we have SORP in July.
Well, I'm good with going with LoSAP, but all right, maybe OPEB too.
Okay.
I mean, if we're going to show up, we may as well do it.
Yeah. Well, and then, Mary Ann, that the investments following the policy statement would be in August, when you would be here.
Yeah.
So
Exactly.
that would make sense.
Yeah.
Okay. So do we need a motion for the July 20?
Change the calendar.
To change the
yeah.
calendar, July
Calendar.
24th?
July 22nd.
22nd, I'm sorry.
I'll make a motion, we hold a meeting July 22nd, 2021 at, what, 10:30 or something like that?
Well, today was 9:30. Do we want to?
Yeah.
At 9:30 a.m.
Okay. Do I have a second?
I'll second.
Thank you. And all in favor, vote aye.
Aye.
Aye. Okay, motion passes. July 22nd. And do we need to have a motion or vote on going to the lower FI, or?
I think
He's
that's
just gonna-
probably in July.
in
Yeah, I
July?
think
He's
that's
gonna-
fine.
He's just going to bring it back, and then we would make the form, okay, based on our indications. Okay. So that would wrap you up, Mr. Wenger?
Yes, sir.
Great, great. And then we would turn to committee reports, which I believe is Ms. Pratson. Is that?
Actually, it's the plan administrator report. So it'd be Jody.
Jody, thank you.
My report is much more brief than what we just discussed. So for the plan administrator report, we have had no transfer of funds or paid expenses since the last meeting on March 25th. We had the future calendar meetings. We had confirmed dates, upcoming dates of August 27th and December 3rd, and we'll add the July 22nd to the plan report based on what we just approved. Thank you.
Thank you.
And we need a motion.
Do we need a motion to approve the plan administrator report?
So moved.
Second.
Thank you. All in favor, say aye.
Aye.
Motion carries.
Aye. Sorry.
Now, I'm sorry, I jumped. New business would be, Ms. Pratson, regarding the Emergency Service Board request for expanded LoSAP benefits.
Yes, thank you. Thank you, David. So you may recall, last year, the commissioners approached the Emergency Services Board and requested that they consider alternative methods for earning points because of the pandemic. The Emergency Services Board responded in October, and their response included recommendations for 2020, recommendations for 2021, and then even broader recommendations for 2022. So what I'd like to ask the board to consider is the point award process for 2021. And if we would approve bringing that before the commissioners, considering changing how points are awarded in 2021, following what the Emergency Services Board asked, what would occur is that we would have a public hearing, and then we would change the code. When we did this for 2020, it was just, the code was changed just in that one specific instance.
And if I recall, it was to earn benefits, you need 50 points, and what we did because of the pandemic was give everyone 25 points that had earned 50 the previous year? Is that-
Yes, yep.
So is what they're asking sort of the same, or are they?
It's right here in the memo, so it's not quite as generous
Oh,
for
this is
21.
the add 4 points per month, right?
For any volunteers who are restricted from participation.
Well, we see, what I guess I don't understand, it seems like we're coming out, and I'm not against it, so don't sound like that, I'm just talking in general. We're coming out of the pandemic.
Right.
I mean, what I really worry about is going to the paid EMS, which is, do we need the volunteers anymore? And if the number of participants in LoSAP goes down, obviously it seems like the payouts go down.
Right.
So the trust would stay up. But what I'm confused about, and I still haven't been able to get a clear picture on, is what happens to the volunteers after we hire all the EMS
Right.
paid.
Right.
This may eventually go away, or we just have to fund it for a smaller and smaller group of people.
Right.
Because what I've also been hearing, and that's again hearsay, is that people who are currently volunteers will be applying for these EMS full-time positions.
Right.
And, you know, there's nothing wrong with that. But again, it gets to be, does the LoSAP need to grow to the amount if this pool is going to shrink?
Right.
Because I think usually we see the pools increasing, whether it would be OPEB or SORP, but in this case, the pool could shrink.
Right.
Right.
So what's your, oh, I should.
But I mean, in 21,
But I'm good with this. This is-
right, because I think because in 21, we're still going to have a mix of volunteers and paid personnel, so there's still going to be room. And again, I guess we have to also think that we're dealing with the fire department as well, right? Not just, the rescue squad.
Right. So we're only adding the 22 positions, which was the 16 EMTs and the 4 paramedics.
Right.
Do we know how many rescue volunteers there are? Do we have that
I
number?
don't know how big the pool is.
Right.
Not offhand. I would have to look, but
I
it's
think the
quite a
total was about
number.
900
Be good
combined, wasn't
information
it?
for the next meeting, if we had a trend on what's been going on.
So we can see how much more the volunteers are compared to the paid that we're adding. I mean, it's still going to be significantly
Well, see,
low.
where I think this really kicks in for me, an example would be, is these people who worked on base.
Right.
And were doing, Lexington Park, Volunteer, or wherever they were doing.
And
And
they
then
were
their
rest-
employers said, look, you got to stop.
Right.
All right, that's, like, those people should be given the points if,
And that's one of the categories.
I get
Right.
it, I get
Yeah,
it, yeah.
yep. And then similarly, if you had a health condition and your
Yes.
physician said
Yes,
you shouldn't
do
respond.
it, right. But what are we going to do when someone says, I just don't feel comfortable?
Right.
Or, I was at the Ridge Ridge American Legion, and the woman next to me was a 40-year vet of the rescue squad, and she hasn't gotten the vaccine, and she's my age. We graduated high school together. And I said, why didn't you get one? Oh, I just don't trust it yet. And I said, you're running these calls? She did something like 2,500 calls, back when, and I said, why would you do that? She said, I got my own immune system. So sometimes you got to wonder about, right, let's give it to them, but make sure it's,
Well, what we're doing at this stage is just pushing it forward to the public hearing where we'll have.
Okay, good point.
Right, ESB members come in and discuss it as well at the commissioner public hearing, and Steve Walker and his group from Emergency Services discuss it, and
I'm sure Sean Davidson will come in
oh,
and
absolutely.
give us hell, too.
So
Well,
that's what
I-
I'd like to
So-
be able to do, is to bring it forward to the commissioners and
Okay.
say, this is what the ESB submitted, the board considered it, and support, a public hearing.
Oh, absolutely.
What about 2022? Is that part of this, or is this a
That's
separate?
the next discussion.
Okay. I didn't know if it was all one or.
So you're just suggesting that on here on your memo, Catherine, that we're just adding the 4 LoSAP points?
We're just going
Yeah.
to, so I'm going to
Okay.
ask two things. So
Or a
the
month.
first thing is that for the 2021 request, can I bring it forward to the commissioners? Would you approve that I bring it forward to the commissioners for a public hearing to potentially change the code for
Right.
2021?
Yeah, so moved.
Second.
All in favor, say aye.
Aye.
Motion carries.
Thank you.
What was your other thing?
Well, the second request is that what they asked for 2022. So that is much trickier. So for 2022, and if you go to the
Oh, this is the
attachment
analysis,
that
right.
is from Chair, I guess it Mark Mattingly, I think is his name.
What's your,
It's dated October 2nd.
okay, got it, yeah. No,
so-
this one's David.
October
This one's
2nd memo?
Sean Davidson.
It's right here, if you wanted to.
Is this
You're
one-
welcome to.
This one here,
Yep,
right?
Yep, you're
So
welcome
it's
to.
from,
When I flip it to the next page,
Yep.
It says Sean.
Oh,
Sean
interesting.
Davison also, right?
Okay.
Yeah.
so maybe,
It's from Sean. Yeah, no, you're right. You're right.
but anyway, this
So-
is what we're talking about.
Right, this is the second item I wanted to bring to everyone's attention. So for 2022, they have proposed, the Emergency Services Board has proposed increasing the points allocated, increasing the dollar amounts that are associated with the points, increasing the benefits that are provided to volunteers, to potentially include access to the county's health insurance plan, property tax incentives, landfill access, and gift cards. And a tiered point scheme is the ultimate goal.
But again, we're talking people with 30 years and, long time in.
Right.
That's a no-brainer for me. I'm good with that because they put the time in. I just, so the short term, the cost could be additionals, but the long term is, again, we need to see what happens to the
Right.
pool. Pool goes down.
So what I'd like to do, what I wanted to ask the board, if you would support, is that we get a fiscal analysis of what that would mean.
We wouldn't, yes.
To the trust if we were to change those benefits. Wearing my HR hat, I'm nervous about providing employee benefits to volunteers.
Right.
So at what point are they no longer volunteers and are they employees? So I'd like some kind of legal
Yeah, I agree
analysis.
with that.
Right.
That's like Kapinski or something.
Right, right. Because it's a slippery slope, right? Because a volunteer could then say, well, I'm really an employee.
Well, it reminds me of, I teach University of Maryland as an adjunct, and I have access to their health care. It's just that I pay 100% if I so desired it, right? So
Right.
it might be something like that they can have access to it, but it would be a much,
That's a
it
nice
would-
deterrent, isn't it?
Right, right. It wouldn't be an 85-15, obviously, right? It would be something, and I'm not saying it would be 100% like the state, but, you know, it's something that you would look at and you would run numbers and make a decision on, right?
Well, and so that's what I'd like to do, and I think we have some time, because it's calendar year 2022 is what they're thinking.
So you're not looking for a motion then?
Well, if I were
For the
to,
study.
if I were to do that, it would be a cost to the trust.
Right.
So
Well,
we
here's
would
what I'd
have,
suggest. I wouldn't want to vote on that today, but maybe at the 22nd, you can come up with some kind of idea what the costs are.
okay.
Yeah.
I can do that. I can reach out to Bolton and Karpinski. I'd also like to do a survey of other Maryland
Yeah.
jurisdictions to
What they
understand
offer.
what kind of
Yeah,
benefits
right.
are
What do they
offered.
provide?
Now, tell me, what kind of number do you have in mind for this study?
I don't know. I don't have any idea what it would
So just
cost.
see what they come back with.
I could certainly do that and then ask the board to vote on that next time.
Okay.
That sounds perfect to me,
Yes.
to more information.
Yeah, we need to know what the cost
Yeah,
is
that's-
Okay.
and what everybody else is doing.
Okay, okay. Well, we can do that. We can try to do that survey in HR.
Okay.
So I'll see if we can get that done before the next meeting. And then, do we want to move forward with the fiscal and the legal analysis?
So
Okay,
the fiscal analysis is pretty straightforward, but then the side note, we think other benefits like access to county health, like you talked about. I mean, those are other questions. I mean, once you allow some volunteers in, are you going to have to let all
You're gonna-
volunteers for the county?
Exactly. What about other
Yeah.
volunteers?
So, I mean, that's like a whole nother.
Our other
That's what we're talking about, the
nonprofits.
slippery slope.
So
Right.
Right.
what, my question then is, what part are we trying to get solved for the 22nd? Just the fiscal of this points and the amounts, or are you going to also look at the county health insurance and things like that?
I think at least see what the cost would be for an extended study for that.
right, or an opinion.
Or an-
Okay.
right.
Anyway,
Okay.
because as you say that, and I hadn't even considered it, but the impact to OPEB.
Sure. Oh,
Right.
the
I
OPEB.
hadn't even thought of that. So, yeah.
Okay.
Yeah.
Well, the other thing, though, is if you can get us a trend on the LoSAP member, the pool. I would assume, just because I don't know, that it's been steadily growing. But if we're going to, again, go to a paid system,
Right.
what does that mean when we
To
have
the
coverage?
volunteers.
Lexington Park wants 72% coverage.
Right. Right. Okay. So, thank you. And so I will bring back estimated costs, estimated scopes of work, and then also an analysis of what other communities are doing. So, appreciate that. Thank you.
Okay, well, that would wrap up new business, I believe, unless anybody has any other new business that you don't know about. Okay. If there's nothing else to be said, I would take a motion to adjourn.
I'll make a motion to adjourn the meeting.
Second.
All in favor, vote aye.
Aye.
Motion carries, meeting adjourned.